Well done. Ah, there's Mish. Great timing.
Plugging the wire.
Mish, all good?
Yep.
Great. Excellent. So we'll start on time. So hopefully we can finish on time and more people will join us as we go. So welcome everyone. It's great to have you here. My name's Neil. I'm head of equity here at Swoop. I won't give the big sales pitch about Swoop, but in a nutshell, we help SMEs and startups get access to funding across a range of debt, grants, equity, and things like that. And my focus is on the equity side of things. And after this, we'll follow up with an email. Put people on mute there. Sorry. We'll follow up with a few guides from Swoop that explains a bit of what we do and a bit of help for founders. And also a link to our podcast, which actually talks to founders and how they raised in the past. But without further ado, I'll just intro everyone and then we'll get into the myths. So first, we have Claire Cherry from, she's a principal at True Global, which focuses on seed and Series A stages in high growth, disruptive brands and retail technology. They also cover private equity as well, so quite a range. And then we've got Mish, who's a general partner at Local Globe and Latitude. Local Globe Seed Fund is focused on UK based and, as the name suggests, seed and impact investments. Latitude is their Series B fund. And then we have Rebecca Todd, who's investment director at Longwall Ventures, which is focused on early stage companies in the healthcare, science and engineering sectors. And then we've got Kieran Burke, who is Swoop's COO and co-founder. And he can hopefully give the founder's perspective as he's done a raise or two in the past. Okay, and yeah, so we're just going to start. How we're going to do it is we're going to spend about 40 minutes going through some myths. We've got quite a few, so we mightn't get through them all, but I'd invite you guys to it's a kind of an open discussion. I'll start with someone, but just feel free to jump in when you can. And feel free to disagree with one another. I think that would be the best and most interesting. Because I know there are different funds out there and different investors that take a different stance on a lot of these things. So yeah, and then at the end, we will go through some of the questions which we gathered from the audience when they signed up. We've got a lot of them, so we probably won't have time for live questions, but we'll see how we go. So anyway, I will start with the first myth. And it's a question mark rather than, we're definitely going to bust this one. But it is, if a VC turns you down for investment, there must be something wrong with your business. So who wants to start here? And I'm just going to actually stop sharing so we can just see people's faces and they come up as they talk.
Well, I think this is the one that I suggested. So I'm happy to kick off if you like, because it's the thing that I sort of feel the most as an investor. So I think most of us probably get, I don't know how many approaches from businesses looking for money every week, let's say 2 or 3 a week. That adds up to several hundred a year. And I make maybe 2 investments a year. So by definition, I'm turning down almost all of the investments that approach. And most of them just aren't going to fit with our fund and our particular taste of investments and our particular investment strategy. And
Has Rebecca frozen or is it just me? Okay, that's unfortunate. Hopefully she'll come back now. But Claire, do you want to jump in?
Yeah, of course. So yeah, I think I can probably build on where Rebecca was heading, but for us it is very important for founders and founding teams to have done their research, I guess, prior to reaching out to us. I think a lot of the no's that we give aren't necessarily because of the business model, but more because of the fit for us as an investor, whether that be cultural, whether it be the stage of the business. I think the more work that entrepreneurs put into researching what funding type is right for them, I guess the more that increases their answer. And, you know, ultimately we end up backing businesses that other funds have said no to. You know, it is a lot about fit for a specific vehicle or specific individual. So I wouldn't necessarily get downhearted if you know, you have heard a no from many other VCs, but I would equally caveat that doing the research and going to a much smaller number of focused investors probably has a higher chance of success than bombarding 500 cold emails where we can all see that it's not necessarily personalized for us as investors.
Got you. And Rebecca, I know you froze.
I'm sorry about that. I don't. I've unplugged my LAN cable and moved to Wi-Fi. Let's see if that's better. But yeah, so I don't know entirely what Jerry was saying, but the message I give to people is that this is more like dating than it is about getting marks on your business. You want to find one or two, maybe, or you know, three if you're raising from a syndicate, of good partners for your business. And that is like, you know, if you have one bad date, you don't think you're a bad person and you have to go away and kind of become a different person because of it. There would just be, you didn't match that other person. And it's the same with finding what will be a really long-term partner and partners for your business. There's there will be people, there will be the right partner out there for you if you're a fit for investing. And the overall message I wanted to give is that most businesses that start at any one time, any one year in the UK, are not businesses that necessarily should be thinking about raising venture capital investment. Lots of people start businesses. There are family businesses, there are single person businesses. There are lots and lots and lots of businesses that start that will never be appropriate for high growth investment capital. And it is important that people kind of understand that difference. They may well need some financing to help them get going, but they are unlikely to be the kind of business, they may not be the kind of business that can provide the high growth that investors are backing. And that's the majority of businesses, despite the fact if you're in London and caught up in the kind of startup ecosystem where, you know, it feels like that's everything. You know, the most businesses that start at any time in the UK or anywhere are not high growth venture capital propositions. So it's important that people understand that difference, because I have seen people raise money because it's sort of the thing to do if for businesses that weren't right for high growth equity. So it's you know, where you define that line is maybe something we'll come on to with some of the other myths, but understanding that is really important.
Yeah, I think that's one that we'll come across in another myth, actually. Anyone else want to weigh in?
Yeah, if I can just quickly add, wholeheartedly agree with everything that Claire and Rebecca said. I just think that kind of beyond the fact that hopefully most founders or potential founders will be aware of that, most businesses do not lend themselves to venture capital in terms of the size of the opportunity they're addressing, or you know, don't fit the investment profile of most funds. Like, I think these are relatively clear, even though some founders could do with a bit more preparation and kind of research before they actually reach out, because it would make their life easier. But I think there is something more profound that's important to acknowledge, and that is that while all of us, like everyone in VC, would like to believe that they can and would identify a winner when they see one, that's just not the case. We can't always kind of see the opportunity that the founders see, whether because we don't have the experience or because we've been burned with previous investments, or a whole host of reasons why we sometimes struggle to share the vision that founders have in their own mind. And so that kind of slightly more philosophical challenge is one that you should always bear in mind. Not everyone can see what you can see. And hopefully, you know, you don't need everyone to see. You just need one or two good partners, as Rebecca mentioned, who share that vision and are willing to back you on the long journey to execute on it. Yeah.
Okay. Kira, do you want to give a founder's perspective on that? Have you gotten a few no's before?
Yeah, plenty of no's. But I think what can be tough, I suppose, from a founder's perspective is when you are trying to find that fit for who the investor is, and you're obviously reading through investment theses. And while I'm sure a lot of the VCs will be quite pure sometimes in their investment thesis, when you go and you might just see it on Crunchbase, you might see it on their website, it can be hard to differentiate them. Maybe you'll see seed Series A, but what does that mean? And it's tough sometimes if there might be some sectoral trends from their portfolio. So there are cases where you'll get to the meeting scenario and it's not working, as Rebecca say, it's not like a date. But what I'd always encourage founders to do, even if they can read the signs and they know the meeting's not going in the right direction, but if they do feel that maybe that fund or that investor is someone they want to work with in the future, or they want to be better prepared for the next meeting, find out what are the one or two things that would have made them interested. So is it a metric? Is it a pipeline metric? Is it a piece of technology that they should have talked about? Is it a partner, kind of a customer size of operation they needed to focus on? So I'd always try, and if you've got the opportunity to have a touch point with the VC at the end of the meeting, or even if it hasn't gone particularly well, try find out what those kind of metrics relative to your sector or business is, so that hopefully when you do go into some of those dating scenarios, you're putting your best foot forward for the next time. That's probably what I'd say.
It's really good advice, because sadly we are really rubbish at giving feedback. And that's a dynamic that comes from the sort of the economics, if you like, of what we're dealing with so many companies. And so, if I get sucked into kind of giving feedback to a company that I just kind of know I'm never going to invest in, then I'm not spending that time working with my portfolio or on deals that I know that are going to be. And it's really, really tricky. There's, I think Fred Destin in the US wrote a really, really good, blog about that, about why we kind of can't get, it's difficult, it just doesn't sort of add up to give feedback, except, we always do. I think we always do if we've been engaged with a company for a little while, but it's really tricky. Otherwise, you could spend your whole day giving people, trying to come up with explanations of why not. And then if any self-respecting entrepreneur will come back and tell you why you're wrong. So, you get sort of drawn into a debate. And so it's really, really, I don't, we're not terribly helpful in that respect. And I sympathize enormously with founders and entrepreneurs that are kind of dealing with that. But equally, it's just a reality of our day-to-day lives. So I don't know if the others are better at it than I am. But
yeah, it's tough. Well, I talk to lots of VCs every week, and it is tough. Some of them, if they manage a one-line feedback, you're delighted, and then others, they just don't have time because of pure volume, and then some people do manage to, but it is just a tough reality of the industry, I think. Okay, great. So we'll move on to the next myth, one that I think is really interesting. And if your company does not have the potential to get to $1 billion to a $1 billion valuation, you won't get funding. So I think there's probably different views on this here, but Mish, why don't you start on this?
Look, I think the one thing that all early stage funds have in common is that they assume power law returns. And so that means that with each and every investment we make, each of us is looking to see a viable path to a fund returner. Now, what a fund returner looks like obviously depends on the fund economics, on what is the size of your fund, what sort of ownership do you get to with your initial investment, and what sort of viable ownership you assume upon exit. Now, just to give some quick numbers, if we have a fund of $100 million and we very optimistically assume a 10% ownership at exit, that means that we need to see a viable path for $1 billion outcome, whether it's an IPO or an acquisition or whatever. Now, of course, different funds have different models. So if the If the fund size is half of that, say 50 million, then you should be fine with, you know, $500 million exit or outcome to return the fund. But, you know, that's only if you indeed assume 10% upon exit and not 5% or 20%. So at the end of the day, it does kind of depend on the fund economics. I think unless you're looking at really small funds, say kind of $10 million funds, roughly 10 to 20, then you can, I mean, I think businesses of $100 to $250 million upon exit are still relevant. I think in terms of most of the seed and pre-seed funds, which are somewhere around $50 to $100 million, $1 billion kind of outcome is relatively a good benchmark. And it's not about, you know, if it's a 800 million or 1.2 billion, but in terms of kind of general area, it just doesn't make sense otherwise.
Okay.
I think you've explained it really well, but just to say that particularly in this country, there are funds with different models in terms of the sort of the business model. Some people have explored patient capital models, the listed models. So, for example, Mercia, that operates out in the regions and not so much in the southeast corner, their whole business model is built on the fact that most companies in the UK don't achieve that sort of exit. And so it's more about having a larger portfolio, a list they're listed so that they're not sort of driving to returns in a certain time frame, and they're not assuming that kind of that sort of return profile, and you know they invest all the way through. So it's, and again, the business growth fund, which is more active in the early stage stuff than it used to be, is a whole nother kettle of fish again. And then you've got different, you know, EIS funds that are pulling angel money together with tax breaks. They're investing on a different basis. So, you know, it's really important to sort of, that's the classic venture capital model that Mish just summarized really, really nicely in a closed-ended fund. But there are other types of private money that invest in early stage companies that maybe have different models, and that's what I would encourage, you know, founders, entrepreneurs to sort of understand what would fit best for them.
Yeah, I was speaking to Syndicate Room this week, and they obviously they don't need the moonshot every time because they're following angels in that respect. So yeah, it is really interesting. Claire, do you want to jump in?
I guess the other perspective that I probably had, and I don't disagree with anything that's been said on the matter, but you know, really it comes down to, certainly for us, kind of how capitally efficiently you can scale your business model. I guess we're in the investment world of backing people broadly that sell physical products. So ultimately, once you get to a scale, there's other routes to finance that than equity. So I guess we don't necessarily suffer as much dilution as some of the B2B or SaaS businesses. So therefore we can probably accept a lower price on exit because we hold more of that business and haven't necessarily gone through that funding round. So I think we are seeing that more and more, and ultimately it comes back to the point of the previous myth where my biggest piece of advice is to align yourself to make sure that your ambitions as a founder are aligned with those as an investor, because ultimately different funds do have very different ambitions for where businesses need to get to, regardless of sector. It's just making sure that you found the right fit from that perspective as much as anything else.
Yeah, got you. Yeah, we might talk about it later on, but and it's an interesting one for businesses that don't think, oh well, I'm not probably $1 billion company, so where do I go? And is it that VC is not for me, or is it I just need to find angel investors? It is an interesting question. Kieran, do you want to jump in?
Yeah, I think there's actually a myth in this itself. Like the fact that equity is one form of finance is a big, massive myth. Like we obviously do a huge amount of debt finance, but you don't go to an early stage business and give them like an unsecured loan, or you'd look and see, okay, what are the data I can give you an early stage business? I'll see, have you got an invoice finance facility? I'll look at invoice finance. Or have you got e-commerce sales? I'll give you a revenue-based facility. It's the same in equity. What founders need to realize is it's not one type of product that's out in the market. There's as Mish very eloquently put it, the VC style model, but there are plenty of other pots that use equity financing in a completely different way. Obviously Rebecca touched on stuff like Mercia, there's the Northern Powerhouse, but all those SEIS, EIS, VCT funds operate a very different model to a lot of the classic VC side of things. And again, founders could always do with putting themselves in the shoes of the person investing or the funds that are investing and go, well, what's their motivations here? How quickly do they need to cycle the cash? What's their appetite for patience? And that again can help you reflect, taking Rebecca's previous analogy of dating, is this a relationship that will suit me, will suit my style? Am I kind of fast paced, like things moving quickly, or do I want to slowly build something over time? And that should allow you to make considerations. But the myth for me is that there's one form of equity finance. So I think founders could do well to spend more time kind of educating themselves on the different pathways that are out there. And based on those pathways, some of them are going to better serve the business, whether it is down an angel network route or going down what is perceived as traditional venture capital funding.
Okay, nice. Two myths for the price of one. Next, we will go to another myth. One that I think is often in the back of the minds of a founder, and it's VC and / private equity here, but we'll concentrate on the venture capital side of things. But VC investors are vultures looking to take over my business. So it'd be great to hear from you.
I prefer vampire.
What?
I prefer vampire.
Vampire, excellent, yes. So yeah, how do you?
But in fairness, actually, it's Jason that Start Code On says that. So I've stolen that horribly from him, and I hope he'll forgive me. I hope it's complimentary. But he says, that when people invest in your business, you let them into your home with caution, and I absolutely wholeheartedly agree with that. You have to understand why they're investing, what they expect to get from it, whether you've got alignment of interest, and just like you wouldn't let a vampire into your home without understanding whether you wanted to allow that relationship to develop. You need to understand how that works and whether that's the right thing for you. So and I think that we have a business model, as Claire touched on, which is based on, and Mish introduced earlier, which is based on how much holding will we have in the business when we get to an exit, and we need to make a return, and that's our business model. And if that doesn't suit, then that's not suitable for you, and we should all be eyes wide open to that. So but if some businesses are to justify the investment returns we need to make, that means holding a larger stake. Some investors have a very clear model. We just have 10%, but we need you to go really big. That depends. And if that's what it means by vulture, then well, yes, and don't take the money. So it comes, and we take a lot of risk in not being in control of that business as well. So we do look for ways in which we can influence and ensure that you stay on the agenda that we've agreed. Because we're responsible to our investors, the pension funds, the private individuals, whoever that's put that money in, that's backing those things. We have that responsibility. So, but that's the business model, and if it doesn't suit, then absolutely don't do it. Find another way, or else do at least understand it. And I think vampire is fair.
Vampires have been glamorized in the movies, so maybe they're nice to themselves there. But it's just a question then. So what can a founder expect from VCs, and how they might be influenced? Is it a board member, or is it advice, or what are the things that a founder might expect?
Well, we all do things slightly differently, and that's one of the things that you should get to know. But you know, for example, we do tend to be on the board. We each individually have very small portfolios. Relatively, we do relatively few deals. We have a small portfolio, and we like to be involved in that business. I don't want to invest though if I'm going to be constantly disagreeing and arguing with the team that I've backed. So for me, it's about, is there a shared partnership? It's a marriage thing. You know, I perfectly fine for me to decide I don't really want to back a team because I find myself policing and having quite a negative kind of relationship with them. The teams that I want to back are the ones where somehow I'm bringing something that helps to the dynamic, and it's positive and it's constructive and it's building something. And that's a, you know, that's a perfectly valid reason for saying yes or no to making an investment. But we all have different styles in terms of the level of involvement, and how much involvement we expect. And again, that's something, you know, to be really open about in the process of doing taking money from investors. You know, but rarely is money of this sort, early stage equity, just a check and you never see them again.
Yeah.
But then I'm aware that we're quite far down the other end of the spectrum in that we do like to be involved we invest very early on, and we like to be quite involved and like to be part of that. That's our model, and that works with teams who like that involvement and feel that relationship is beneficial to them. But less so for people that don't. So
yeah, it is interesting. You need to get to know the VCs. That's really, and it's a tough job because there's lots out there. But it needs
you only need to get to know the ones that you're talking to about potentially investing. In fact, to that level, you know, this is where the dating's moved on to courting.
Mish, you might be able to offer a view on, you know, the early stage and the right up to Series B, in terms of influence and what founders might expect there.
Look, I think obviously we can all speak only on behalf of our own funds. We operate under a very strong notion, and it sounds almost trivial and to some people perhaps cheesy, but we abide by it very strongly. We back founders, and the businesses we back are their businesses. We are not in the business of running companies. It's not what we do. It's not what we are well positioned to do in any way. And so at the end of the day, when we back a founder, it's because we have conviction in their capacity to lead their company. And you know, that isn't to say that there won't be certain disagreements down the line, but at the end of the day, you know, this remains the founder's company. I think beyond that, when we don't have, and that probably applies to all of us and all of the VCs I know, when we don't have conviction in the founder's capacity to build a business by themselves, we're very unlikely to make the investment, because I don't think any of us believe that we can, you know, contribute as much to kind of make or break the company. That's not what we're in business for, and that's not something you should expect investors to do. Sure, there are kind of edge cases where we can kind of step in and make a meaningful difference at an inflection point or a challenging time, but that shouldn't be kind of the course of business. So that's how we think about it. In terms of involvement and portfolio support, that's honestly a much broader issue, so difficult to kind of elaborate on in 60 seconds. But I think it's always kind of about finding the right balance between proactively providing value add, whatever that is, whether it's around fundraising or business development or hiring or whatever. But actually, many times it's about taking a step back and letting founders focus on, you know, delivering the thing they want to deliver and give them the peace of mind to do that. So it all kind of boils down to what is the best thing for the company at any point in time.
Got you. Claire, do you want to jump in?
No, I'd agree on that. I think from my perspective, and yeah, I guess it depends again entirely on fund, and to Mish's point, we can only talk for ourselves, but I think the market definitely is going through kind of a segue between, to Rebecca's point, some of the more generalist focused investment firms, I guess, where they don't have sort of such a high sector specialism or thesis, where you can probably expect that they're more hands-off than probably any of us on the call, where we like to think that we're investing behind thematics and founding teams that are there to execute that, but we probably can add value given the experience that we've seen in the market. So again, it comes to doing that research in terms of what you want from an investor. Certainly some will be more hands-off than others, but certainly the model, as you probably gathered, doesn't work for any of us to step in and run portfolio companies at all, but it's ensuring that we can trust the founding team to build out the senior team around them to execute on that, which I think is probably where a lot of us are involved for a big chunk of our portfolio.
Okay, nice. And does anyone, just throw a question out there, does anyone have any horror stories of people where maybe an angel has tried to take influence in a company that you guys invested in, or another VC? I don't know. Maybe if anyone had an example.
I can jump in. I guess I'd say that, yeah, for that regard, it's important to consider all sources of funding as you go through. I don't think there's any such thing as a truly hands-off investor, whether that's an individual or a fund, and ensuring that everybody is on that same journey. We've had challenges where perhaps a founder took money from friends and family, which is dangerous in itself, and then ultimately, I guess their alignment was very different from the founding team in terms of where they were trying to grow that business, what the key dynamics were. So since then, the rounds have been challenging because, I guess we're aligned with the founder in terms of where we're going, and then we have shareholders there that are probably more active than we might like. So I think it's just to be aware that, as you go through that journey, that everybody's brought along for the same outcome and the same anticipation, because otherwise it will probably be challenging.
Yes.
A story that I've seen more than once in particularly, I suppose in medtech, it's perhaps particularly an issue because of the nature of the market. I don't know, but I've seen more than once is a major private investing, a family office, someone with significant amounts to invest, is invested in a startup, and the valuation is quite high, and they have a very large stake. And then the company needs to go out and raise, an institutional round from knowledgeable specialist investors, really, because of the nature of the business that they're building. And it's not really possible because the valuation is too high. That private investor doesn't want to take the dilution. And they just sort of didn't really understand the journey they were getting started on, and what the next steps would need to look like. And that has happened. I've seen that more than once, just as a sort of a pattern. And it is, it's one of the things that I talk to people about, is to understand the journey that they're embarking on, and what the financing steps will be, and to ensure that what they're doing at the beginning is laying a foundation for the future rounds. And knowledgeable seed investors that are used to helping their companies prepare for the next investors and the next rounds should be able to help with that. But but I've seen that's a common place where it can go wrong.
Yeah, it's I think it's very difficult for founders to actually, when they're concentrating on their product, I think probably to know all the different stages of investment and what happens with dilution and preference shares and all those things. All I can do is suggest reading Venture Deals. It's a good explanation of it. Cool. We'll go on to the next myth. This one was sole founders don't get funded. I think this was also asked by one of our audience as well. So is this true or is it false?
I can jump in. We've backed some previously. I think for us, it is hard to back a sole founder if it is just them in the senior team at the point of investment. We rely heavily on founders being able to hire people into their vision. And frankly, if we haven't seen any evidence of that prior to investment, it's probably harder. I think we can probably count on one hand the number of people that have managed to scale a business on their own without a good senior team around them. So for us, if it is a sole founder, that's important. But I would say we've equally had situations where we've had to exit co-founders from the business at subsequent rounds. So, I think there's both sides to the coin in terms of, again, a founder or a co-founder has to be picked very carefully. So I'd probably rather be building a senior team around a very strong person than trying to exit a co-founder where it hasn't worked out after, 2 or 3 years of building. So yeah, it's not a no for us.
Okay. I think you want to submit this one.
Yeah, it kind of continues to emerge more often than I'd expect. I think, for us, this is another example of thinking in terms of what is the right thing for the company. And, some companies do great with a solo founder, and some companies not so much. And I think it kind of boils down to the question of, when you are looking at a founding team, whether it's 1 or 2 or 3 or 4 or 5 founders, and we've seen and backed all of these constellations, do they have the critical mass of, commitment, passion, skill, expertise, and company building capacity to deliver? Now, sometimes you don't see that within a team of 5, and sometimes you see all of that in abundance in a team of 1. And so kind of avoiding any clear templates of what a founding team should look like, I think in my view is preferable. I had a quick look at our portfolio, and I think about 15% of the companies we backed had a solo founder. So it's not loads of them, but it's a significant amount. And I think it's, I think it's very difficult to call a certain correlation between a solo founder or not versus the outcome. Just like, sometimes it works great for the company, and sometimes less so. Really depends on the circumstances.
Yeah, I can imagine. Kieran, could you have done it by yourself? Or Andrea, could you have done it by yourself?
She definitely couldn't. No, I think it's just the team dynamic. I think, as Claire was alluding to, is well, I feel how we're being analysed when we're going through any our previous funding rounds, or how we're being analysed is usually tell us about yourself. But it's like, give us your background. What are your strengths? How do you guys come together to run a business, and where could they potentially give influence to us? But also to the previous question, like, are there shareholders or advisors there that can also prop and give value to this business in certain areas, depending on what sector that business might be in. But in terms of, like, if we're talking to other founders here who are interested in this topic, it's like you're going to be analysed based on what your attributes are relative to the business and how you could scale that business. So if you don't have a natural technical ability to code, and your business is about technology, then you're definitely going to want to be able to talk about how you would hire those people, or how you're connected into a good development network or a good product network to be able to go roll that out. So again, it probably just goes back to awareness that if you are a solo founder and you are pretty passionate about what you do, and you have an amazing business that is worth VC backing, then always talk about it in terms of what your personal attributes are, but how you can power up a team around you to kind of go and conquer your mission. But from our side, I think we're very comfortable as a duo and as a dynamic, and I think we definitely bounce off the fact that there are 2 of us and not 1 of us.
Okay, nice. Guys, we have a few more myths, but actually I want to get to the questions, and some of them from the audience are sort of like the myths, and hopefully we have some of the people who ask these questions in, so they'll get what they might have been looking for. So the first one here, and this is kind of on industry trends, but what are the current top 5 sector focused market segments for VCs? I know this is going to be different for all of you, but let's do the top 3 and just quickly give maybe either one word on.
I'm sure there's data and reports that say where the money's going. I'm usually wrong in terms of thinking, because I kind of deliberately want to invest where other people aren't necessarily looking. That's just kind of like my preferred philosophy. But you've got to include health at the moment, and the medical space is just exploding, but particularly obviously digital and its application in health. And I'm looking forward to a world where the term digital health doesn't mean anything anymore, because it's just part of it. But that's clearly finally, I was around for the first digital health boom, which was in the late noughties, and then that all collapsed, and we're kind of in a world where we seem to be getting proper adoption. So that's obviously an area, but I wouldn't like to guess others.
Yeah, well, actually, sorry, we'll change the question to be kind of the ones that you guys are interested and excited by. But yeah, we've seen a lot come through that have gotten quite a lot of traction in the healthcare space and the digital healthcare space. So it's been a really interesting space.
I can jump in. I guess the top for us is, again, certainly the health side of consumer, whether that be products, digital solutions, I guess the intersection of the two. And then it's really a core focus around sustainability all the way through from materials, products, technologies across kind of every area of our business. It's probably the top of mind for early stage entrepreneurs through to some of the largest corporates. So I'd say that for us as a thread is obviously not going anywhere over the next 5 years.
Okay. Mish, do you want
to? That's not one I can help on. We are genuinely sector agnostic, and we invest across like all sectors when it makes sense.
Even personally for yourself, you don't favor any industries?
I mean, I focus on B2B. Quite a bit of that is kind of within frontier tech, but it's not that important to me whether it is or isn't. I guess quite a bit around business operations and automation. But beyond that, I mean, it's data design and developer tools, infrastructure, security and privacy. But it's we really, I mean, I think there is a fundamental difference between areas where you have made investments, have done research, and have a meaningfully prepared mind, and where you're actually looking for investment opportunities. And the two are not necessarily coupled at any point in time.
Interesting. You might think that some investors might get cozy in one industry and they follow on investments, but good to know.
Well, I think we all naturally you get cozy with areas that you kind of get to know better until you come across a super interesting opportunity where you feel not cozy at all, but still very excited about the opportunity, which is a good enough reason to dive into it and learn what you need to learn to assess it.
Yeah, Kieran.
Yeah, I suppose just if we were to take like some of the data that we would gather from our own platform in terms of if you're more likely to get it if you're based in London in this sector, like what our data shows us and what we see is like if you're food and beverage or you're B2C and you're based in the UK, your odds of getting equity finance are greatly diminished relative to being a technology-based business or a B2B business. It's just you're starting off on a tough path. And because we would see a huge amount of food and beverage startups because there's a big wave obviously of changing of food and people are very passionate about it. So there's lots of pop-up stores, just better products. But until you're hitting $1 million plus in revenue, until you're in at least a Sainsbury's plus in Asda or a Sainsbury's plus like Virgin Trains, then looking at that kind of VC equity side of things, it's not even a goer. Like take Jamtree, who would have started out of the Innocence Beauty brand, they wouldn't even want to touch anything to do with food or beverage. So again, understand what sector you're in, and particularly B2C. There just isn't that many. There are some general firms out there, but in terms of like, if you're to say throw enough things at a wall and show law of averages and stuff like that, within the UK market in that B2C space, it's just not as populated as it is compared to the B2B space, which is why, going back to the earlier point around, that doesn't mean equity funding isn't for you. I would just say, if I'm in the food space, B2C space, I wouldn't really be going down the VC track unless I had significant metrics, whether it was consumer adoption or decent revenues on that early stage track.
Yeah. Okay.
I think we've kind of inadvertently debunked another myth, though, which is that this is how we think about these things.
Yeah.
Actually, I mean, what Mish is sort of much more typical, I think, in that, actually we're really backing people. And if it's somebody who really knows their space and their market, then we might break all our rules. If they're somebody that we just think is an absolute superstar, the most early stage investors, I think, are, it's about the people than about the kind of the market, and so these sort of questions about where's the money, it definitely, I hear what you're saying, Kieran, it increases your odds or decreases your odds. But if you're in a space that's out of favor, but you've worked in that industry for 30 years and you spotted a real opportunity that you've spotted because you really understand that industry and you know your customers, and then you're probably quite a compelling proposition regardless of what industry it is, so long as the growth opportunity is there. The basic fundamental VC economics match the fund, but the sort of, that's really, it's a people business.
Yeah. True. That's why I spend a lot of time talking to founders on the phone each week, just get to know them. So we touched on geographies there, and there's an interesting question here. Someone asked, are valuations cultural? Why do companies seem to always have a higher valuation in the US than the UK, or even the UK versus the rest of Europe? And I think there was another question about, it was a myth actually asking, do I need to raise substantial amount of capital? Do I need to set up in the US? So what are your views on that? And in terms of, are there certain sectors that are just better positioned to be in a certain country or location?
I'd be interested to know whether others agree with me, but one of the things I spend time myth busting is that valuation really means anything in an early stage business, because it's actually a function of the size of the funds that are investing and how much people want to invest. It's what comes out of the calculation of how much do we invest and what stake do we have, and there isn't really a real meaning to the valuation of a company in the early stages. And in the US, there are bigger funds and there are bigger exits, so you come up with a bigger valuation. But the decision as to whether to go to the US or not is really important. It's something that I kind of have quite early conversations, especially in the medical space, because that is the most attractive market. And whether you go to the US early or later, or but quite often with quite a lot of the companies I'm dealing with, there isn't really a question as to whether you will or not eventually, but it's more like how and in what form and when. So that's because it's just a different market and it's so much bigger. If Europe was equivalent, maybe, but we don't. That's not how we work in Europe. We're looking at the UK. UK is like looking at, California or Texas or Florida. We're that sort of dynamic. But so the bigger exits, bigger funds, bigger valuations. That's just how it goes. And there are US investors looking at the UK and the technology here, but mostly I suspect they would be looking at things that they would expect to come across the pond.
Yeah.
And that's what they're tapping into. But I'd be really interested to hear other people's perspectives on that.
I mean, from our side, I certainly agree on sort of bigger funds, bigger funding rounds. Certainly, if you would look at equivalent businesses and stage in the UK and the US, it's obviously materially different. That's partly as a function of their funding industry and how much, ultimately venture capital was probably born in Silicon Valley, and there's just a bigger appetite for risk, would be my take on the market over there. But equally, it's because that upside is materially bigger. I don't think there's any one industry where that wouldn't be the case in the US versus the UK. So yeah, we would certainly see most of our businesses going there relatively quickly from a consumer perspective. You know, it's an English speaking market on both the B2B side and D2C. And I think, yeah, that's borne out in the price that people are willing to pay, because if you look at the equivalent, you know, I can get into 2,000 Walmart stores as an opening PO versus 5 Sainsbury's. You know, it's not equivalent in terms of revenue potential. So I guess that drives both growth and also valuations from my perspective.
Okay. Miss?
I can touch on this quickly. Just to emphasize Rebecca's point, valuations definitely at seed and pre-seed, but increasingly so at Series A and B and sometimes C and D mean absolutely nothing. At the seed or pre-seed round, evaluation is just an outcome of a balancing act between ownership for investors and dilution for founders. That's it. Which means that it's a question of, you know, demand. The more demand you have, the better terms you can get. I think, obviously, you know, when you're operating in a less competitive funding landscape, you have less options, you would have less demand, and so the terms may be not as optimal. I think nowadays for founders in the UK, and specifically kind of in the major hubs, whether it's London or Cambridge or Oxford or Manchester, Bristol, Leeds, the seed funding landscape is now quite to very kind of evolved. And so if you have a good opportunity to fundraise for, you should be and can raise on you know, very good terms.
Yeah.
So it's like most things, it's just a question of demand.
Okay. Nice. Yeah, it makes sense. There's also the question of, what do you use convertible notes, and does that grow in the EU and the UK like it did in Silicon Valley? But one for another day. I wanted to touch on, we've got 7 minutes, and this one came in a number of different guises. But I'm going to put 2 questions sort of together. One of them is, every VC I go to says, come back when I've made dollars. How can I do that when I need the dollars to make what it is I'm raising for? And then the other question was, what is the most important validation or traction you can show a pre-seed investor? And so I put these 2 together because I think they kind of lead on to each other. And interestingly, RLC released the top 5 reasons VC rejects startups. So maybe that feeds into it as well. But yeah, it'd be interesting to get your view on, you know, the putting the cart before the horse, so that old chicken and egg situation.
I suspect the real agenda there is not being ready. No, nobody wants to turn something down. You know, so as much as though we spend our lives turning stuff down, we kind of also, you know, it's good business for us to keep an option, to keep the option open to invest later. We just haven't got the conviction yet today. That's actually what a lot of the time is happening. And you kind of try and say, you know, if you can get that far, then maybe I'll feel confident for the next stage. We don't do that very much because we're very early stage investors, and our preference is either to get in or not. But a lot of the time when people hear that from investors, I think that's really what it is. It's not a sort of scientific thing. They're kind of saying, you know, and a lot of people take this feedback and take it very literally, like we're kind of sitting here with spreadsheets of metrics, and when they add up, we'll invest. We're not stock pickers. That's what people do when they buy stocks on the analysts do for the city. We're backing teams and people and opportunities. So this sort of idea that if you can tick enough boxes, it'll somehow be right is one of the myths to debunk, I think. But I think a lot of the time when people are hearing that sort of feedback, they're basically kind of saying, I want to see you a little bit more, understand a little bit more. I haven't got enough at the moment to get conviction. And at the end of the day, our job is to, find a few things to back. So, the one that gives us more conviction is the one that gives us, that we'll invest in. I love the use of the word conviction. I know, I think I heard it first when I came into Local Globe's office. I think it's a concept that sums it all up somehow.
So just to build on that, I think, as we mentioned before, different funds have different risk profiles. So some funds are just not set up to invest pre-revenue, and that's absolutely fine. They have a different risk profile. Some funds are comfortable investing in pre-revenue businesses in some kind of sectors or business models, but not in others because of their prior experience. And that's absolutely fine. I think, again, this kind of goes back to the question of doing your due diligence on investors. I can say in our case, not just in pre-seed, but also at seed stage, and we're talking about rounds of, say, £1 to £3 million, many companies, if not most companies, are pre-revenue, and many of them are pre-product. So, that's how we think about opportunities. And much like Rebecca mentioned, we're looking to get to establish conviction as early as possible, so we can back those founders as early as possible. Sometimes you have some fundamental concern about the business, which you believe might be mitigated by seeing more traction. That happens, but I think that kind of boils down to how different funds think about assessing risk.
I think I'd also say that, for us, a lot of times we see founders seeing revenue as being the holy grail, whereas for us, traction or early indications of uptake from the market take many other forms and not just revenue. We will look at how you've built a community. Have you got evangelists that you're bringing in regardless of whether you've got something to sell them? There's a lot of avenues that I would say entrepreneurs don't necessarily explore probably frequently enough before they look for VC funding. And it's about painting that picture of storytelling of the traction that you have got and how you've probably hustled your way there on a shoestring. We'd much rather see that than necessarily going out to raise funds, I guess, without achieving that. So I would definitely say that that's something that we don't see enough. Some founders do an unbelievable job of, I guess, getting to that MVP, iterating, getting something out there, showing strong traction and metrics, regardless of revenue, for a matter of months or before they come to us, which again puts them, even if we can't get there, to Mish's point, from a risk perspective, I guess it's still building that story such that when they come back to us, we have much clearer visibility on where we would need them to be and can probably give more guidance.
Yeah, I actually just want to build on that, because sometimes it is a question of, listen, you need more traction here. And even the VC might give specific reasons or specific KPIs that they want them to hit. How often do you get founders that come back and say, here, I've hit those KPIs, will you please invest in me? And then how often do you go and invest in them? Or do you set them new targets? Or how does it work? And what's your experience there?
So from our perspective, we certainly see that. I guess, we invest all the way through from pre-seed to Series A. I'd say most of the time I've met these metrics, but and then it's a question of, I guess what priorities are. And frankly, it's definitely something that we take seriously if founders did come back to that, but it's certainly not a be all and end all. And I guess it comes to Rebecca's point previously, where partly the reason why we don't set metrics in stone, certainly from my perspective, is that that tells 10% of the story, not 100%, and it's never going to be a kind of be all and end all if you hit certain financial KPIs predominantly that investors tell you. It's again the whole thesis and the whole theory that you've built around that. So we'll certainly entertain it, and most of the businesses or founders that we know, ultimately we've probably met a year, 2 years, 3 years prior to actually making that investment. So it's not harmful to see things early and to continue that conversation, but it's certainly not a slam dunk by the time it comes around.
Okay.
This concept of hustle is a really nice one, because it's, I mean, I know it's really easy for us to say we're not the ones out there trying to start companies and raise the money for it, but I had a really, really interesting a story that really inspired me right at the beginning of my career, which is, and it was before the days of Kickstarter and that sort of thing, but there was an entrepreneur who talked about his journey, and he had this idea for a product, and he had a really strong concept. He was a repeat entrepreneur, repeat serial founder, and he got really he had a very high awareness of kind of his opportunity cost, that he didn't want to waste time on something that he didn't think he could deliver into a great business. So he put, it's just back in the days when this was the sort of thing you would do, he put an advert in the back of the newspaper for this product, because he wanted to know whether there was a market out there for it. And the audience is sitting there going, but you didn't have a product. What did you do? And these people were writing you checks. And he said, well, I wrote them a letter back and sent the check back saying I'd be in touch when we've got the product. But it showed me that there was a market there, and I had a list of customers ready for it once I got it. So, there's that I sort of worry slightly in the world that we've got to, where there is so much equity finance and assumed seed financing, that some of that kind of, gritty, get out there and hustle a bit and see how you can get going is not sort of the automatic thought process. And then, as I say, it's really easy for me to say I don't have to do it. Yeah. But that sort of entrepreneurial creativity. Have I got a business? How can I prove I've got a business? How can I get some initial proof? I don't expect he would have had much trouble raising money. He got a list of customers who wanted to buy the product, and he just needed to go away. It wasn't, it's a consumer type thing. Just needed to marry the two, but because he had the proof. That counts as traction for me.
There is a modern way to do that with digital advertising, and then
exactly
very smart. But Kieran,
it was more automatic. I think there were fewer people doing this sort of thing, and there was more of that kind of, not an assumption that people would invest.
Yeah.
So
Kieran, you want to jump in?
Yeah, there's a couple of things. Well, one, I just think that's a really good valid point from Rebecca, in that if I was in the investor shoes, I want to earlier point of like, I'm backing the person, so I want to see them be tenacious and show that they really care about the business and they can make it work. So I think it's a bad attitude, that statement in itself. The second one was our experience with funders in terms of hitting targets and stuff like that is they understand it's flexible and it's movable, and you're working with them. Even when we've had term sheets and they'll have specific metrics and stuff around there, they talk into our experience with our own investors have been making them just very achievable type things in working together, and you can always kind of move or change them, and hasn't been kind of lock you down to this. And the final thing that I thought might be a good outtake for any founders on this call was, if you're trying to work out what the different metrics are, and as Claire alluded to, they might not all be financial. One thing, we were on an accelerator with Middle Game Ventures once, and they introduced us this viral framework where you analyze your business across 9 different segments, and essentially you're giving yourself a score of 1 to 9 based on where you are in team or revenue or business model or whatever it might be. But it was just a really useful exercise for Andrea and I to kind of just set aside and just give ourselves a score for each of those sections and what we would need to do to get us to the next level. And overall, your total company score is the lowest one you are across the mark. But it kind of lets you see where you're maybe strong or weak, or what metrics you would want to talk about when you are meeting an investor, or what ones you might want to avoid in the first case. But I just thought maybe we could share that framework as part of the wrap-up notes. But personally, I found it useful. I mean, other people might have different opinions on it.
Certainly. I've shown that viral scorecard to lots of founders, and they find it really useful. It's all about being honest, I think, as a founder with yourself, and really knowing what stage you're at, and being able to back that up when you can go to an investor. Guys, I want to be respectful of people's times. We've run over by 5 minutes, there's lots of questions, and we couldn't get to the live questions, so we'll follow up email some of the questions that I can answer because they're binary, or I know the answers to them and they're not opinion pieces. I will try and answer individually, so we'll get to that. But I think there's been some good feedback already in the chat, and I really appreciate you guys joining us today and giving your thoughts on it. So thanks to Claire, Mish, Rebecca and Kieran, and thanks to everyone for joining us. As I said, we'll do the follow-up email with details on what we've discussed today, a bit of swoop guides, and hopefully answer some more of your questions. Oh, and the viral scorecard as well. Cool. Thanks, guys.
Thank you. It's really enjoyable.
Thanks a lot.
Thanks, man. Bye bye.
Bye bye.